the reading.
Okay, we're gonna call a meeting to order for the General Employee Pension Board meeting. Roll call.
Larry Lee,
Here.
Troy Cruz,
Here.
Wendell Bowden is absent, Laura Nettles is here.
Okay, if everyone's had a chance to look at the previous minutes, they'll have a motion to approve.
I'll second.
All in favor? Aye. Okay, River Place Capital.
Good morning. I am Mark Ross from River Place Capital.
Yeah, you wouldn't Peter out.
I know, Peter is hiding for obvious, no, there is no way to sugarcoat.
You the one who takes the rock.
Peter wasn't gonna show and Scott wasn't gonna show either, so here I am. So I have not done these so if I'm leaving anything out, please let me know. I'll kind of breeze through what I've got here. It has not been a pretty year to date, as we all know. We are growth investors. I'll run through the numbers here real quick, but we are long-term growth investors. Things do look like they're turning around here in July. July and August look much better than it did for the first half of the year. So we are excited about that. We do think the worst is behind us, is what we're looking at right now, and our predictions moving forward. So we are making some shifts in the portfolio that you'll start seeing here. We're adding some names, and I'll kind of run through a couple here in just a minute, but I'll run through numbers real quick. I don't know if I was supposed to give you first.
Thank you, sir.
You can leave one in the, Casey.
All right, so most of the guts of the report are on the first page that you'll see. And
In the big page,
actually it's gonna be on page number 2. So where we see the performance numbers. And year to date, and this is ending June 30, so it's in the bigger package, not the smaller. I'll do the smaller stapled package to get a second. So through 6/30, the performance numbers for River Place Capital negative 16.4, whereas the S&P was negative 12, NASDAQ was off 23.67, and the Russell was off 19.70. Again, we are underperforming in that category because we are growth investors. It has been a value year to date. I mean, through June anyway, we are seeing some stronger numbers on the growth portfolios, which this is moving in from July into August, and we're seeing some better numbers here the last 2 days as well. So what I do want to point out is I think we are turning the corner, and I didn't do the whole report for July and August, but just to give you an indication of the direction that it is moving. River Place Capital, and this is why it's important to stay invested in the market as well, because when things turn, they turn generally very quickly. So our numbers at the end of June were negative 16.4, and at the end of July, it's down to negative 9.65. So that's a pretty big improvement in a couple of days over a month. So we are trending in the right direction. I do want to point that out. The other thing that we've seen is we've seen a dramatic increase in rates, if you haven't paid attention to that as well. So On the fixed income portion of the portfolio, we're finally able to go in, and you've seen a lot of treasury and CD and corporate buying that we've been doing here within the last several months. So we've gone from returns on the fixed income side, and when we're looking at the fixed income side, we hold everything to maturity. We don't trade the fixed income, so we're looking at whatever the yield to maturity is when we actually purchase that security. So we've been doing that, but we've gone from, where we were only able to get a 0.5 point or 1 point on the fixed income side, we're up into the 3% range, 2.5 to 3% range, depending on maturity. We are staying in 1 to 5 years on fixed income still, because I think we're still going to see some. So we'll be able to reinvest those as the time comes. I guess kind of questions at this point. I mean, is that the format? I don't know how far to
You're doing good so far.
go on this. I'm sorry.
So you're doing good so far, that's how Peter normally does it.
Okay. So you'll probably see a rebalance here very shortly. So when we go in and rebalance a portfolio, we're able to take advantage. So we're bringing everything back to a 2% level is what it is. I mean, so each position, so in other words, it's forcing us to buy things that have underperformed and sell some of the winners, bring it back to a 2% position. You'll see us do that. We're talking about it. We're not quite pulling the trigger on that yet, but you'll probably see us do that in this.
I see where BlackRock is down, is that a concern?
BlackRock on the stock, no, I would not be. It's part of the cycle, but no, I would not be. It's not out of line. Our outlook moving forward, I think, I think the worst is behind us. I think we've said that as well. Doesn't mean we're not going to have some more volatility. There's some unknowns out there. We've got elections coming up. Show up to vote. So, ready for questions, or tell me what you want to hear.
You've always got good questions.
I mean, that's fine. I mean, the only difference is Peter normally makes kind of a rundown through each page real quick.
Okay.
That's, I mean, you painted the overall picture. I mean, and we knew, like we said,
Looks like John, you're doing pretty good.
we had warning of this, so it's not unexpected.
I will say, as you move through the reports, you will see the activities. As you move deeper into the pages, we have not made a whole lot of changes. We have not done big dramatic changes in this quarter. You did see us add Qualcomm to the portfolio. That is some of the things that we're out there looking for at this point, is kind of the days of growth where you were just chasing growth and not wanting to fight, as markets and stocks were moving forward. Now it becomes more and more important in this type of environment, growth at a reasonable price. So, you look at something like a Qualcomm that we just added to the portfolio, you'll see in the activities.
What do they do? What do they specialize in, Qualcomm?
That's chip manufacturers. So they, now.
Where are they based at? Taiwan, China, or?
No, that's here. Actually, that's outside of my category. That's I don't know the answer to where they're based out of. That's now trading at a 13 times earnings, which that's a very reasonable growth projection on for that type of stock. So that's a good value. That's what we're going in, looking for at this point.
So what you're saying, there hadn't been any drastic moves to fixed? There hasn't been a drastic move of funds to fixed
No,
income?
we have not,
Okay.
because we're still in the 70-30, and that's kind of what that's been our
Right.
target, all along. So deviation from that. Now, what I will say, we do have some what we call holes. So typically there are 50 stocks in the portfolio, in the, large cap growth model. You have seen, we do have some holes. So I believe we're at 48 stocks in that portfolio right now. So we're not in a rush to keep it at that 50 level. So we may have a little bit of extra cash sitting on the side because we haven't filled some, we haven't filled some of the holes as we typically would.
Okay. Anybody
But
else?
that's just about all of them.
Anybody else? We good?
NASA's company there, so.
Any other questions? All right, we
Okay.
appreciate it.
Yes, sir.
Sterling Capital.
All right, good morning, everybody.
Oh, I had a question, I'm sorry. Mark, what was your last name?
Ross.
Ross, okay.
Yeah, I wrote it.
Mark with a K or a C?
With a K.
Okay, just for the minutes. All right, proceed.
All right, guys, it was ugly. I mean, there's just no sugarcoat and no two ways about it. Really, again, what we saw, what we talked about last quarter was, everything that could have gone wrong all seemed to come to a head in the first quarter, and that just really kind of continued here in the second quarter, and really just got worse in June. What we saw was, again, the most disappointing part, I think, for a year to date is, you guys have been doing this for a while, you've been following stocks, you kind of know that, that the price of being in the pension business or being invested in stocks is we got to put up with these negative 15, 20, 25% periods, right? We kind of did it in Y2K, we did it in 2008 after the financial crisis, and we did it again with the pandemic. What makes this time different, I think, than those other three is, at least in those three time periods, the bond piece of the portfolio was there to kind of be that ballast or be that buoy, right? To prop us up when stocks were down so significantly. What makes this time different is the Fed all but admitted that they kind of screwed up in not, putting the brakes on this recovery a little sooner, and that's led to inflation. So now they're so fearful about inflation, they've got to raise interest rates to quash inflation. And that's obviously very, very bad for the bond portfolio, current bondholders, right? When rates go up, it impacts the price of bonds. So conversely, what we saw the first 6 months, the S&P 500 return was the third worst in the last 52 years or something, since 1970. So, I mean, I'm only 54 years old, seen a couple of cycles, but I mean, that's like the third worst start to a year in my lifetime. And it's the worst for bonds because of what the Fed has had to do. They had to raise rates 50 basis points in March, then they ratcheted it up to 75 basis points or 0.75% when they met in June. That's the first time they've done that since like 1994, right? I had no gray hair back then, right? And then they had to do it again in July at 75 basis points. So they have really ratcheted up rates very, very quickly in a short period of time. The one sort of silver lining, as Mark sort of alluded to, was, at least now you can make a little bit of money, a little bit of income on the short end of the fixed income market. Whereas before you were getting 10 or 15, 25 basis points, now the 10-year treasury is in that 2.5, 2.8 range, almost 3. So, I mean, you can make at least a
So
little
our
bit.
30% sitting over here at least is not going off a cliff.
Yeah, and we
right?
think the worst is probably over there too on the fixed income side. The Fed's, the market's already got priced in at least another 50 basis points worth of increase by the Fed when they meet again next month in September. That'll probably ratchet down to maybe 25 in the December meeting.
So they're not expecting 3/4 again?
No, we're not. Well, we were up until we got some pretty good data earlier this week, and that's kind of gone below a 50% probability after we saw the CPI number come in
A little bit
lower.
down.
Yeah, a tick lower than we had expected, and we're starting to see some of the data come in like that, where we're starting to see it roll over ever so slightly. which gives us at least a little bit of hope for, the second half of this year and into next year that, all right, maybe the worst is already priced in, both from a stock and a bond side. And then the other thing that I've really been emphasizing this quarter is, this year is gonna be bad, right? We've had bad years before. But we gotta just go back just 1 year and go look at what the plan did in fiscal 2021. The plan was up over 23.5% between the two of us, right? So 23.5% is literally 3 times what we would expect in a normal year, right? We expect somewhere around that 8% range, right? So we got almost 3 times that in 1 year. So we probably borrowed some of the returns, and we've certainly given some back. I didn't think we'd give it back this quickly, but again, we had a nice little cushion.
I know the city's contribution this past year was unbelievably low. Like, I think I told you before, but it was startling, because I remember the day when it was $700,000
Yeah.
a year, and sometimes more than $700,000. And Donna said last year it was $75,000, the city's contribution.
Yeah.
Because our funds were.
Yeah, and again, one of the other things, and I know you've got your actuary that's gonna come on a Zoom call. One of the things is he doesn't recognize all of that 23% each and every year, right? So it wasn't just a one time. We're gonna get a portion of that this year, portion of it next year, and the year after, depending on how he smooths out that return a little bit. So again, we're in very, very good shape from that perspective, so I wanna kind of reassure you there. But again, the correction we've seen is really, I hate to use unprecedented because that's like a little over dramatic or whatever. It's just we haven't seen in a very long time stocks draw down this quickly and have the bond piece of the portfolio also off double digits. To give you an idea, in my report over on the second tab, we've got all the benchmarks and the time periods for quarter, year to date, 1, 3, and 5. Up there at the top is the Russell 3000. That's kind of like the S&P 500. Fewer more companies, right? But still the U.S. benchmark off 16.7% for the quarter alone, and off over 21% for the first 6 months. So again, just terrible returns. Then we sort of break it down into the growth and value components of the Russell benchmarks. And you guys have heard me talk about this before. And as Mark pointed out, it really was an environment where those value names did much better, right? And again, the difference between a growth stock and a value stock, just to jog your memories, is the growth companies tend to do a little bit better when times are good, right? And those are companies that are making a lot of money and growing their businesses. And a great example would be maybe like Starbucks, right? Yeah, they're growing their business, so they're plowing more money back into opening up new branches and making more money. Whereas the value companies are usually older, more mature, they pay dividends. The example I used for years until they got bought out was Budweiser, Anheuser-Busch, right? They're just chugging along, they make good solid earnings. They're not gonna grow at 20, 30% because people aren't gonna drink 30% more than they did. But it's probably the last thing they cut when times get tough, right? And you could almost argue that when times get tough, they probably drink a little bit more than they would otherwise. So they tend to hold up really well when times get tough. So that's the kind of environment we've seen, and those value names have done very, very well so far this year. And you can see it, the top 200, if we look at growth versus value, just for the quarter, the value names, while they were off 11%, that was one of the better performers. Growth was off closer to 21, and for the year, it's even bigger. It's like 11 and 27% negative. So again, we've got you in a very diversified portfolio.
We were in a good spot when this happened.
Yeah, and again, we were coming off a super strong year, and you guys were, we had really a decade of phenomenal growth. I mean, we were joking about, just gosh, I remember when the plan was 6 or 7 million.
Yeah.
And, my half of the plan got up to like 13 or 14 there for a second, up over 25. So again, just kind of phenomenal returns. And down at the bottom, just to give you an idea of how bad it was for bonds, these numbers are just as bad as I've ever seen. And I've been doing this since the late 90s. Off 4.7%, that Bloomberg aggregate index, just for the quarter. The year was off over 10%, 10.3. I mean, those are just numbers you don't see, right? And again, that's in direct correlation with the Fed raising rates so aggressively. So, as you guys know, it's kind of similar to the old Truist material. The rest of this first section is a lot of economic data. We got a lot of charts talking about how we're analyzing this and looking at that and dissecting this and that. But again, suffice it to say, you know, all of it leads us to really believe at this point, man, we look out to the rest of this year and our crystal ball's as cloudy as everything. I mean, there's just no sugarcoating. I mean, there's a lot of variables in play. What we think the most probable scenario is the Fed will continue to raise rates at the September meeting, maybe take a pause at that last meeting of the year, and we'll start to continue to see improvement from an inflationary perspective like we saw in the numbers this week. You know, employment number came out it was funny. Employment number came out last week and it was phenomenal, right? We created 3 times as many jobs as anybody expected and the market traded off significantly. Because everybody was like, okay, that means the Fed's gonna have to raise rates more than we currently thought because the economy isn't cooling off like they want it to.
How do y'all get those jobs numbers? Who do y'all depend on?
Well, when you look at those jobs reports, it's a bit.
I know what President told me why.
Yeah, it's a bit misleading, because again, the other part of the quote unquote unemployment number is you've got to actively be looking for a job. So there's a lot of folks out there that are still, you know, the participation rate is what they call that, is really low, right? It's by historical standards, it's usually 70-75%, because there's always going to be some seniors that are just super wealthy and, you know, I don't know, they inherited money, they don't have to work, right? And then there's always those, you know, on the lower end, the younger kids that are in college and of working age, but aren't working because they're going to school or doing something. So the average participation rate is usually about 70-75% of the workforce. It's now in the like low 60s and has been stuck there really since 2020, you know, kind of ratcheting back up. So from that perspective, there's certainly a little bit of cloudy in that number.
Who do y'all depend on?
Well, again, we look at a lot of the stats that are out there. There's you know, all kinds of, you know, data sources. The government is one, but then there's some independents as well that sort of verify some of the employment data. And they're taking, you know, surveys and projections from companies. Are they hiring? Are they not hiring? That kind of stuff. The exact name of some of those companies I could get you. I don't follow it that closely.
So they interpret the job rate, you know, going up as a good sign that the economy is growing. But could it be that inflation is so high that retirees are having to go back to work? Or college students are having to get a job?
Well, what we saw specifically last week was the market reacted to that really good jobs number by saying, oh, we think the Fed is now going to have to raise rates longer than we did previously, before we got that data. But then we turned around and got the good info on inflation this week, and you know, again, all of that sort of affects like the futures rates and where things are going, and the odds of the Fed having to raise rates 50 basis points versus 75. And if you watched on Wednesday, you know, there was, you know, the market was saying there was a greater than 50% probability they were going to have to do 3/4% again in September. As soon as that inflation number came out, that ratcheted down to under 50% now. So it's more likely that they're going to go just 50 basis points.
How high do you think it'll eventually get?
Probably in the mid threes. You know, we're sitting at a Fed funds rate right now. I think it's like 275, 250 to 275 is their range. If you look at the market, they're expecting it to top out later this year, first part of next year, in that 3.5 range. And then if you actually, we're starting to see for the first time some pretty good signs that, you know, later in 2023, the market is expecting it to kind of roll back over and the Fed to have to decrease rates. And really what they're saying with that projection is, we think we're going to go into a recession, we're going to slow the economy, then the Fed's going to basically have to prop us back up again to get us jump started.
Yeah, isn't the ideal is for them the rate, let me see if I can remember how they say this, is the rates and the inflation, they want it to closely match before they stop. Am I hearing that right?
What they're really looking for right now.
Their target is 2 to 3% with inflation rate?
Correct. Correct. And the number that just came in, Troy, was 8.5.
8.5, yeah. So not zero.
They are a long way.
Not zero like some people said.
No, they are a long way away from their target rate. Yeah, well, he might have misspoke. I'll give him the benefit of the doubt because he's my
I
elder.
know he's lied.
But let's just say I didn't vote for him.
I'm not political anymore.
No, completely off the record.
On a red flag list.
So again, that's kind of our best guess, is that we are starting to see incremental improvement. We think we'll continue to see that, but it's gonna be it's gonna be just like we've seen the last 2 weeks, right? We get a good jobs number, the market trades off, 2 or 3%. We get a good inflation number the next week, we bounce right back. So that kind of volatility and that kind of bouncy ride, we think we're in for the foreseeable future, unfortunately. So, but again, we're a pension plan. We need to, even though you guys are closed and we have, a smaller amount of people, we still have a very long-term perspective. And again, we've weathered storms in the past, similar to this, and we'll weather this too. And again, we were in pretty good shape, I would say excellent shape, coming into this first 6 months into this year, so.
We're in better shape we could have been.
Oh, yeah, we definitely had a very good run.
Just to give y'all perspective, I always add them up. Last quarter, we were at 26 and we're still at 21,890, so.
And that's as of June, so, you could probably add another 500,000 or so just for July, and where we sit today, maybe even a mil, between the two of us. So,
Right, so-
again, we're bouncing back a little, but we could give that up by lunchtime.
Yeah, so it's probably gonna be like this for the rest of till the middle of next year.
Yeah, and again, at this point, I don't think we're gonna be able to dig out of this hole in time. The other part was we had a pretty good start to our fiscal year in last year. That first quarter of, the fourth quarter of 21 was a positive number. So it's a little bit better than these year-to-date numbers that we're talking about today. And we've had a pretty good 6 weeks to this quarter. But we're not gonna have a positive number, and we're certainly not gonna get to our assumed rate.
Dollar wise, I don't think it's as bad as what I expected.
No, probably not. Bonds have done a little bit better. They've kind of stabilized a little bit now that it looks like most of the interest rate increases have kind of been priced in. So we're not expecting another 10% downside from here out of bonds.
Just what are energy companies doing right now? I mean,
They're-
growth.
Well, that energy is kind of an odd sector.
Are they exploring any or?
They're because again, what we saw was
Captive some.
oil got way, we were pushing $5 a gallon on crude, right? And we all know that's now down in the mid threes. It's still kind of high, but diesel has been sort of the other one that's a little bit puzzling. That has not come down. That's still about $5. And, that's obviously how most stuff gets transported and gets to market here.
I really don't.
So that's one of the other things that's kind of keeping that 8.5% inflation stubbornly high is that, that fuel cost, diesel cost is really a tax on everything.
Everything.
If you really kind of think about it. It may not be on us, but it is indirectly because guess what? Everything we
Company
buy,
can't grow if they can't get.
correct, everything in the grocery store, everything we buy at Home Depot,
Construction.
everything we do. So the other part that, the Fed, we're starting to see, with the Fed interest rates, we're starting to see the housing market, and I'm sure you know this, Laura. Now the mortgage rates are back up in the 5s and darn near 6 range. We're starting to see a bit of slowing in housing. And housing is another one of those sectors that we follow very closely because it touches everything, right? It really does impact so many different aspects of the economy. So we're starting to see some of that, kind of, and while it's a bad sign, it's actually kind of a good sign too, that maybe then the Fed, will stop raising rates a little sooner than expected. They're starting to see some of the desired slowdown in the economy. But, then we get that employment number where, we blow it out of the water and you're like, wow. So that's the kind of environment we're in. We just, it's kind of one of these 2 steps forward, 1 step back. It really depends on what data you get and this week versus what we see next week. And that's really kind of what the market's going to trade off going forward. It's just a very uncertain time. There's a lot of variables and just sort of the range of outcomes is
Very volatile.
is as large as I can remember. We could easily have another 10-15% down from here out of stocks. But then if the Fed is right, we could see another 15-20% upside in the next 6, 9, 12 months. It's just, it's so cloudy.
They're still hoping for that soft landing, they call it.
Yeah, we certainly didn't get it this year. So again, guys, to give you some perspective on, I just wanted to kind of go through our report because some of this material is a little bit new. It's actually the first time we've used the Sterling stuff, so I just wanted to kind of go through it for you. I do like it a lot. I think there's a lot more information here than in the old Truist material, and you know, some of it's kind of financial geeky statistics and that kind of stuff. But again, I think it really does a good job of describing how the portfolio has performed. You know, over on tab 3 on page 14. Very similar to the first couple of slides. You just see a real overview of the asset allocation and then some cash flows. The next couple of pages, we get into the performance in a little bit more detail. On page 15, we got that same graph that we've used it previously, and then we get into the portfolio performance. Again, not a long period of time under Sterling. It's just year-to-date numbers. We transitioned the portfolio in last December, so over there on the far right, you can see, you know, we're a whopping 21 basis points ahead of our target benchmark, but you know, that's, again, nothing to write home about when we're off over 17%, almost 18%. For the quarter, kind of similar numbers. Again, a little bit better than the target, but certainly not what we like to see from an absolute sense. Over on the next page is some of those risk statistics that I was talking about, those financial geeky stats up there at the top. A couple that I think are worth following and worth tracking is, you know, first of all, we haven't had a whole lot of data points, so a lot of these numbers really don't mean a whole lot now, but will going forward. But one, the standard deviation, that second column there, you can see we're a little less than the index. We're at about 11.25 versus a little more than 12 for our target there. And that's really just a measure of volatility, or how much we would expect, you know, the portfolio to differ than that index. And then another good one is beta, right there in the middle of the chart there. And beta is another measure of volatility. And if that index goes up 1% with a beta of 0.92, we would expect our portfolio to go up about 92% or 0.92, and vice versa. When things get tough and the portfolio goes off 1%, we would expect to only lose about, you know, 92% of that 1%, if that makes sense. So again, we always strive for keeping that beta a little lower than the target, but want to have a return higher and risk lower, and that's kind of what we're striving for. The rest of the material goes into a lot more detail. The asset allocation comparison on the next page. We've got the full pie chart. This really kind of shows the diversification in the portfolio. You know, all the blue and purple slices there are equities, and the green is the fixed income. The purple is the international, the blue is the U.S., but you can see we were slightly under the target there in stocks for the quarter. That helped us a little bit, a little overweight cash there. Again, trying to keep a little powder dry, if you will, for some opportunities going forward. And then the next 3 or 4 pages really go into the category level and asset level performance for each and every one of the categories. Just to give you an idea, I'll start over on page, 18. Our first sub-asset class is large cap value. We've got about 817,000 invested in that category, about 8% of the plan. You can see for the quarter, it was off about 7.7. The benchmark there, the Russell Top 200 value, was off closer to 11%. So good outperformance. And then for the inception all the way across, off 8.5 versus 11 so far this year. So, and that I am very, very sad to say is the best performer on the page. It's negative 8%. Now he did really well relative to his benchmark, but he was still off 8% for the year. So again, there was just nowhere to run or hide.
You know, most keeping up with inflation with it.
Yeah, you're not kidding. So again, not a whole lot of data, guys, and obviously, you know, as we get more time, you know us, we want to evaluate managers over full cycles. A couple of quarters is great, but I want to see how they do, good times, bad times. But that'll become a lot more pertinent to us going forward. And then over on page 20 and 21, we take it all the way down to the individual investment level. So instead of the category level, we've got the individual investments that we're utilizing. So again, there, that Sterling Equity Income Fund is one of ours. That is the large cap value piece. So you can see it's done pretty well in this kind of environment as the market has really rewarded U.S., it's rewarded value, and it's rewarded large cap. So it was kind of the perfect environment for large cap value to do very well. But then we've got all the other investments there too. Again, won't spend a lot of time there. Just, again, that'll be a lot more pertinent going forward. And then lastly, in the appendix, we've got a list of all the individual securities. Recall we took 3 or 4 of the larger mutual funds and sort of utilized model portfolios or individual securities when we transitioned over to Sterling. So consequently, we've got a lot more individual names in the portfolio than we had in the past. But we still, again, basically have the exact same concept there with, very well diversified exposure to U.S. and international, really trying to find best-in-class companies to invest in.
So next and last column, the current year, what does that mean? What their growth was in this quarter, or is that just?
On that particular name, the current yield is usually their dividend payout. So for example, AbbVie, and you see the 3.54
Yeah.
on that first page, that's their dividend rate. So again, that's one of the large cap value holdings, and typically those pay, pretty solid dividends. One of the things that Sterling does emphasizes in its process, in its stock picking process, in that large cap value portfolio, is dividends. There's a very high degree. They want not just companies that are paying above average dividends, they want companies that pay consistent dividends over time. So again, that's one of the tenets of their process that really has helped them out over a longer period of time as well. You'll see some of the growth names too have very, very little. Some actually have 0 over on the next page. If you look down towards the bottom, you'll see Alphabet, and both the A class and the C class shares, and you'll see their yields are 0. They don't pay a dividend at all. So if we're looking at that from a stock perspective, that yield is the dividend rate, and then if you look at the bond portfolio, that's really their coupon. If we look at some of those bond names farther back towards the end. But great question, Larry. So there's a lot more information, a little more detail, I think, in the Sterling reports than we've gotten previously in Truist. I obviously can't go through as much or as little detail as you guys would like, but again, I think having that available to us, I think is actually a plus and an improvement from where we were. So I'm gonna stop talking because I know you want to talk to the actuary, get his opinion here in a minute or two. But before I do, let me just see any questions, comments, thoughts?
In our last discussion, didn't we finally wind up with the idea of matching what the state does somewhere in that neighborhood?
We were talking about lowering the assumed rate of return to get a little more in line with what the state has done over the last several years.
And I can't remember that percentage number, but I wanted to say we talked about 6 1/4, or is that?
The state, I'll have to admit, I don't know exactly where they're at now.
It might be
They're in the
7.5.
6s. I think they're at least 6.75, but they're trying to get down as low as they can get. Now, obviously, that was a very easy conversation to have a couple of quarters ago.
Yeah,
Coming
it's a lot
off a
harder
3.5 year where, all these cities were contributing a lot less than they did before. So what we were seeing in some similar cases around the state was plans could literally lower their assumed rate of return, and it wouldn't have an impact on the city's contribution at all. Because again, we've made so much money, it's built it up, it sort of offset each other.
So
That
there'll be
assumed
more
rate of return
pushback
is
now. Yeah.
Yeah, that assumed rate of return is a big
You would think we need
impact
to
on their contribution.
watch it a while.
But again, it's to the extent that we can lower it at all, I think you're moving in the right direction.
Anything, yeah.
Correct.
So we'll see what they
Is he
say.
logged in yet?
He's on?
Oh,
He's
okay.
been waiting for the last 30 minutes.
Oh, okay. Hi, Mike.
Give me 1 second to unmute him.
Good morning.
Good morning.
Full house, I see.
The usual.
This one, actually,
This is Mike Terry, the actuary.
Good morning.
You wanna ask him questions, Troy?
Yes, sir. what we wanted to talk to you about today was the possibility of lowering the benchmark and get your opinion on that.
Lowering the benchmark.
Yes, sir.
Well, you talking about my evaluation assumption?
The actuarial benchmark for the plan. Assumed rate of return.
Well, that's fine. I mean, I don't care. I'm not sure what you're trying to get at.
Well,
You have my email that I sent to Laura, right?
Yeah, I'm looking at it. You wanna read it for me?
Hey, Mike, my name is Blake Whiten from Sterling Capital. I don't know if we've met, but I think what we were talking about in the previous meetings, Mike, was the potential impact to the city's contribution of lowering their assumed rate of return. One of the things that we talked about is, in my other Florida municipal, police, fire, and general plans, we've seen a trend over the last several years, sort of mirroring the Florida retirement system in lowering their assumed rate of return. And we know that's going to have a big, impact on the contribution to the city. So the board was wondering, just how big an impact lowering their assumed rate of return might have.
Well, I guess that's certainly worthy of wondering, but to me, it is what it is. And my recommendation is we need to lower the current rate down at least 7. FRS is at 6.8. They're probably going lower than that. So that's our target. But to me, we do it over the next couple of years. We're going to have to do it all at once. So I think our goal should be at least 7. But I've already said that in my email. That's the target for my assumption. Now, what your target is different. Your investment target should be whatever you can make. Nothing to do with the. I'm on the liability side. I'm not on the asset side. So, what I discount the liabilities at is sort of to be in line with everybody else, conservative, but it shouldn't dictate your investment policy.
Gotcha. So what is the current assumed rate of return?
I'm
7.25.
7.25.
Okay, so it is pretty low. Gotcha.
Mhm.
Again, Mike, I've been with this plan for several years, and I know we haven't really talked, so I didn't know you were lowering it. So I brought up to the board that a lot of my other plans were lowering the assumed rate of return for the liabilities. And just wanted to make sure, and I guess the board didn't know that we were doing that at the same time.
Yeah, we did.
We kind of thought we were still at 8%. So I think that was the crux of what we wanted to talk to you about, was making sure that we were in line with the other plans and weren't out of line from a state's perspective, because we don't want to get in hot water, if you know what I mean.
Well, the goal on this plan, in my view, is if we're if it was in 1981, we have already sold out these liabilities. Okay, but because interest rates are so low, we can't buy them out. But that's what our goal should be. Right now, you might be able to buy the liabilities out at maybe 3.5%, but we're assuming 7.25. So the cost would be like double what you're looking at least. And so that's why that's the long-term objective, is how can we keep the assets around, wait for the interest rates to go back to where they should be, and then buy them out. That's our goal. So that's what I think our goal is.
Sure.
Not sure what you guys think, but
For a closed plan such as this, that makes a lot of sense.
well, I mean, it's a closed plan, and we only have a couple of people left that are active, and so very soon it's going to be, within 5 years, all retirees. And so to me, we still have to manage the plan. It's not worth trying to deal with it if we could sell it out. If we could sell it to an insurance company, we would do it in a heartbeat, at least for mine, I would do it in a heartbeat. Like I said, in 81, I actually did this with a lot of plans. Sold out the liabilities. I think we got like 12% interest on the calculation. We were assuming 8, so therefore it was a no-brainer. We don't have that luxury today, so we just have to be patient and wait. But meanwhile, we want to bring the interest rate down, so the difference between what the insurance company would charge and what we are assuming would be close as possible, so it won't cost us too much more to buy them out. I know that's probably how you weren't thinking about it, but that's how I think about it.
No, it's not about what we're thinking.
All right, so
I think you're, again, if he's using 7 1/4, I think you guys are, in really good shape.
Okay.
Anyway, we need to have a recommendation about what the assumed rate should be on October 1st for the next valuation. So the board should
Yeah.
make a recommendation on what they would like to use, and either I accept it or reject it. And I can tell you I'll accept it. Okay?
right.
But you're the guys that have to say.
Well, I think what you said was reasonable. I mean, if the state's at 6.8 and you're recommending 7, I think we're right there with them. So, and I think that's our goal. So,
Well, that's the question, is do you think the city would allow you to go to 7% right away, or should we do it over 2 years? And that's a discussion maybe with the city, not with me.
Maybe we should table it and decide at the next meeting.
I was gonna say, Mike, do you have an idea of what lowering the assumed rate of return by 25 basis points down to that 7, what that would do to the city's contribution? Not an exact number, obviously, but a back of the envelope estimate, just to give the board some idea of what it might cost them?
Well, that's a good question. I haven't looked at it. I would probably have to at least look at, you may be able to look at it, see what it was last year. Not sure if I have it.
Maybe that's a takeaway, ask him to kind of just give you an approximation, that way you can talk to the city and say, yeah, we're at 7 1/4, we'd like to go down to.
I'm looking to see if I have it.
This.
What'd you say, Mike?
he's checking.
I mean, he's checking, but.
Oh, it's turned around, said something.
Yeah, he said he's checking to see if he has it.
And it won't be exact, but it'll at least give you a ballpark idea, somewhere to start the conversation with finance, right? And say, hey, we're thinking about doing this, the state did this, you wanna stay in line.
Well, it's really hard to tell because of the fact that you had such big gains last year. And it masked what the difference in cost would be, so I can't really figure it out right now.
Yeah, I knew that was gonna be hard with all the volatility.
Well, it's just that last year we paid off the unfunded, and so the difference in the numbers are masked by the fact that we wiped out all the bases, so that's why I can't pull it out and use last year as an estimate. It's all marginal. I would, given the fact that you're in a surplus state right now, it's almost not free, but it's not going to cost that much because you've got surplus to cover it. So what happens is when you value, you get larger liabilities at a lower interest rate, but you have the surplus to absorb that effect. So I think you could probably go to 7, maybe without a big change, but for sure we can cut it in 2, maybe go to 7.1. And that's what I think the board should at least consider. And maybe what you say is recommend 7 and see what the city says. They probably ask how much it costs. Maybe I'll be able to study it then, I'll be able to do it. And they won't care because the fact that we're just spreading the surplus.
Right.
I'm talking about the surplus from last year. Now, I know that some of that's gonna go away with the evaluation this year. But as he pointed out, I think I heard it right, that the asset averaging will smooth that out. So I think you should either recommend 7 or 7.1
Okay,
as a recommended rate for next year and see what the city says.
all right, that's what we'll do.
Thank you.
We appreciate
All
your
right.
time, we appreciate your time, Dave. Thank you for waiting.
Oh, sure.
Yes,
Laura,
sir.
do you have any questions?
I think that's what we wanted to go.
Yeah, I think we're good. We appreciate it.
Okay,
Have a great day. Uh-huh.
Thank you.
That's interesting.
It does seem reasonable, right?
Mhm.
Yeah, because we had such a good year. Yeah, probably-
Gone.
He's about to be.
So, all right, so that's what was happening years ago, whenever they said nothing was happening.
That was a news flash.
So,
He acted like it was playing. That's what I heard.
Talking about
well, I think that's been a standing thing for years, that if they could do that, well, they would, when it gets to that point.
Oh, yeah, I mean, again, you guys are a very small plane.
So what happens at that point to our pensions?
Well, there's nothing, I mean, they're still in good shape, when you actually sell them off to an insurance company, they basically assume all the.
They just take the liabilities,
They'll
that's
take it
just,
over.
just like selling mortgages to somebody else.
Correct,
So we still get our payment.
yeah.
Yeah, yeah.
Yeah.
Somebody else is just liable.
I
Right.
thought it meant that we would get, they'd buy us out like a lump sum.
No, they basically would assume.
No, because whoever buys that, whatever's left in the end, they got it, just like the city would if they held on to it forever.
Yeah, but like.
If there was anything left.
So
So then we quit managing the plane.
No, I don't think
No,
so.
the insurance company would just take it over, right?
But I
Probably
mean,
put it all in bonds and
They
they'd
don't-
amortize it.
Oh, in other words, they would manage it, there wouldn't be a board anymore, okay.
Correct, we wouldn't need a board, we wouldn't need, but again, to the extent, we're nowhere near.
But it's got a long way to go to get there, he said
Rates are
that,
still
yeah.
so low,
Yeah,
right? Even if we get.
in other words, we gotta go back to the days of them paying 5% on your savings account before we get there. If I'm assuming, if I'm hearing it, and Lord knows when that'll ever happen. Okay, no, but no, to answer your question, I think that's been an ongoing, the city's had that stance for a long time.
Well, that's probably why they closed in the first place, right? They're trying to get away from the liability of
Yeah,
unknown contribution, right? That's why they're pushing everybody into the
right,
the 401k, the defined contributions, right? Where the participant takes all the risk, not the city,
Right, which is exactly why,
which is why pension is so valuable.
exactly.
do we go,
Personal.
okay,
But
so,
I guess all these years, I did not know that he was lowering his assumed rate of return.
I did not.
no, I don't think any of us,
I think at the last meeting, we were trying to determine what that was.
Yeah, I mean, nobody
What
knew.
that number was.
We don't know because we don't get anything from them. From the finance department.
But at least he has been doing it, which I think is, very, very good, obviously. Because it's kept you guys in good shape, right? Because you were still at 8, but it stayed at 6.8.
yeah,
That was my fear, that's why I
Yeah.
brought it up in the first place, was I don't
so,
want you guys so far out, out in left field that it's gonna cause an issue.
so,
So he was talking about us making a recommendation to the council. I thought we had the ability to change the benchmark. Our benchmark.
Yeah,
And I was trying to determine who did it.
so,
Authority, nobody knew.
so do we have,
Who said that?
can we entertain a motion to send a recommendation through finance to the council, and then they can decide whether or not it needs to be on their agenda or not for approval?
I think we should research it and see if it needs to be a council appointed and council vote, or if it needs to be a group of people. Because I wanna say, I remember when Roger was on the board, we voted on it once before and it did not go to council.
Again, I think all you need is a conversation with either the city manager or finance director, listen, you know, our actuary, Mike said, we had him on a call. Mike said we should go down to 7%, we're at 7.25. It's gonna, he says it's probably gonna have very little impact to your contribution, because last year was so good.
Mhm.
What do you think? Let's see what they say.
Well, who's been lowering it all the way? I mean, they've just been doing it without letting it.
Yeah, and that's why Laura's recommending that we do some research between now and next meeting and confirm the approval process.
Yeah.
Yeah.
Okay, so we'll do,
How you gonna do that, by going to, finance and asking them or somebody?
Yeah, well, I like it to be more than just me. I mean, like if we could set up even a Zoom meeting, so I knew you're really busy, but if you had like a 15 minutes,
Yeah.
30 minutes, and we could.
yeah, we can do that.
It just sends you a link and you just click on it. And it opens up here on your computer, or I think you could do it on your phone too.
Like my phone.
Well, no, you probably can't.
But,
Flip phones don't
Larry still
work.
got a flip phone.
Yeah. But you could always come up to my office and I got, my big screen computer and we can sit there and look at my office. It's not a big office, but it's big enough for two.
okay, so we'll get with Donna and see if we can set that up, and then we'll just,
I don't have a problem coming up and go down, just let me know.
My office is right next to ours, that's why I was thinking that's closer to your house.
okay. So we'll do that, and so do we wanna, look at next meeting date?
Yeah.
Is that November or October?
It's usually November. So
No,
is Thursday like the only day y'all can meet, like,
It's not the
I
only
know it
day,
messes you up.
I thought we always kind of did it around police and fire, when Peter came over.
yeah, but they switched, they're all switched.
yeah,
up.
she's not on fire anymore.
Yeah, so
She's not on
I
fire.
don't even know when their next one is.
That'd be the 11th, which is that's Veterans Day, but I think they observe it on Monday, or do they? No, I guess so.
It'll be the 10th, the Thursday.
Oh, I'm sorry, that's Friday, yeah. So Thursday the 10th.
At 11.
Okay,
Yeah, and that obviously works for me, but really the whole rest of the week, if there's another day that works for you guys, works for me too.
that's fine. We're good with that.
Just let me know when, maybe they throw it down.
Okay.
If we're good with that, then we can adjourn.
I'll do whatever y'all want, whether you wanna do face to face. Might be better if Linda don't get my face to face or I might get mad.
All right, we're adjourned.
Motion to
Here we go.